Welcome investors to my channel Fiscal Voyage. My name is Felix. And if this is your first time visiting my channel, make sure to hit the subscribe button because I'm doing a series covering the different dividend aristocrats. And what exactly is the dividend aristocrats? These are companies that have been growing dividends for 25 or more consecutive years. So make sure to hit the subscribe button so you see the latest video of the next dividend aristocrat. And in this video, we're going to be covering PepsiCo. This company has been growing dividends for 48 consecutive years and it has a credit rating of A+. So watch towards the end of the video because I'm going to provide you with a fair value price and a recommendation of either is a buy, hold, or sell at current prices. Okay, the stock analysis on PepsiCo Inc. Ticker symbol PEP. I'm sure you guys heard of this company, Pepsi. It's an American multinational food, snack, and beverage corporation. And some of the most name brand products that they sell is, of course, Pepsi, Diet Pepsi, Mountain Dew, Lay's chips, Gatorade, Tropicana, 7-Up, and Doritos, to name a few. Okay, let's look at the fundamentals. From revenue grew at a 1.7% annual growth rate from 2010 to 2019, which is not great. This is a big company, very big company. But the revenue growth rate is very slow. Net income is basically at the same rate at 1.6% in the same time period. But they do have a great credit rating of A+, which is investment grade. That's real good. So the likelihood of going bankruptcy is very, very low. Operating income in that 10-year period has grew only 2.4%. And earnings did slightly better overall at 3.3%. And the past 5-year earnings has been growing a little better at 4.9%. And net income has done even better at 7.6%. But revenue has still been flat for the past 5 years, only growing at 1.6%. So we continue with the fundamentals. For 2019, the company had adjusted earnings of $5.53. Net margin came in at 10.9%, which is compressed versus 2018, where they saw a net margin of 19.4%. However, this 10.9% is in line with the previous year, so this is normal here. Return on equity is great at almost 50% return on equity. Currently, the company has a dividend yield of 3.09%, which is modest. It's a nice dividend yield. I like that yield. 5-year dividend growth rate of 9%. And they had a most recent dividend increase of 7.1% in May. It just shows you how strong this company is, that they were able to grow the dividend at 7% during this pandemic, this closure of economic closure. So that's something very A+ there on their side. Currently, the payout ratio is at 76.8. This is based on 2020 expected earnings. So I expect this dividend payout ratio to be lower for 2021 earnings. But right now, the dividends, in my opinion, is safe. I don't see them, cutting it. Obviously, they just grew it at 7% in May. So the likelihood of a dividend cut soon is unlikely. And they've been growing dividends for 48 consecutive years, which is outstanding. They have a charter rule of 12, which is just exactly where I like to see it, which is the 5-year growth rate of 9 plus the current yield of 3. So that 12 charter rule is very good. On a side note also, the 5-year dividend yield average is 2.84% and currently is at 3.09. So it's slightly better at current yield versus their 5-year average. So that's good news there. That might be a good indicator that it may be undervalued. So we'll continue going forward here. So let's look at the balance sheet for Pepsi. The debt to cap is at 64%, which is good for this size company. Current ratio at 1.10, which is lower than what I would like to see. I like to see a 1.5 or higher. But like I said, the credit rating is A+, so this is okay. Debt to equity, however, is pretty high. It's actually higher than Coca-Cola's, 3.06. You like the lower the better for debt to equity. So 3.06 is a little concern here. And the price to book ratio is actually high at 13.62 versus the 5-year average of 12.9. So the price to book is high. I like to see price to book of 4 and less to really bring home the valuation for the company. And over here, it looks like it may be overvalued based on price to books. So we continue with the future outlook. Analysts expect 2020 earnings to be $5.34, which is lower than 2019 earnings of $5.53. I'll show you the fast graph with the percentage difference. However, for 2021, analysts expect a rebound of $5.87, which is higher than 2019's. CFRA has projected 3 years earnings growth of 3%, and my dividend drill return model has a projected total return of only 7.3%. This is because of the low earnings growth, and the current price. So that's why it comes with a 7.3%. I like to see it at 9% or higher, but 7.3% is still good. You're still making money annually, so that's positive there, but not where I like to see it. The company has a current PE of 24.3 and a forward PE of 24.8, which is based on 2020 earnings. So obviously with 2021 expected to be higher, the PE should drop lower, but the 5-year average is right exactly where the forward PE is. So it might be fairly valued based on the PE and other things that we saw earlier. So if we look at the fast graph, the black line is the monthly closing price, the orange is the earnings with a multiple of 15, and the blue is a normal PE with a multiple of 20. So based on the past 8-year average, the company tends to average around a PE of 20. And right now the PE is 24.2. So if we see here from now, current prices till 2022, you may have an annual return rate of 4.2%, which is you make money still, but it's not great. And most of that return is from the dividend, which is 3.09%, as you see there. So right here is a good indicator based on the fast graph that the company may be overvalued, fairly to slightly overvalued. I would like to see it at a PE of 20. Right now the PE of 24. So that's where I would like to see a P of 20 or less, maybe around 17 or 18. As you can see here, from 2019 to 2020, earnings dropped by 3%. And same thing from 2018 to 2019, earnings has dropped 2%. So they've been in a decline. Obviously, with the pandemic, it lowered earnings slightly, but not too much, but still. And as you can see, 2021 earnings are expected to increase by 10%, and on 2022 by another 11%. But the company has been very steady. If you look at 2013, it grew at 7%, 6%, and then it dropped by 1%, and 6%, 8%. So the earnings growth is still there, just not at the high double-digit rate. So if we look at the fair value price, CFRA has a fair price at 150, Morningstar at 140, Fast Graph, we just saw, at $122.47. This is based on a PE of 20. And Yahoo comes in at $143.29, and my dividend discount model analysis at $148.53. For this analysis, I use a 7% dividend growth rate for the next 3 years because, again, the earnings is not going to be growing tremendously. So that's why I have it as 7% for the next 3 years. And after that, 6% with a discount rate of 9%, because I don't see this company as a high growth company, obviously, but they're going to continue growing definitely. So I see that's why I use a 9% discount rate. So averaging out the 5, we get a fair price of $140.86. Currently, the company goes for $132.22. Mean is undervalued by 6.5%. However, even though it's undervalued, I have a recommendation as a hold. So my recommendation for PepsiCo is a hold. And the reason why I have a hold is because it's a great company. I actually own shares of this company, and I think it belongs in everyone's portfolio. I just don't like the valuation. It's the same thing with McDonald's, yesterday's video. Everything is great about the company, fundamentally is great, but the valuation is what I'm concerned with. I like the fact that the company has been growing dividends for 48 consecutive years, and this most recent dividend increase was 7% in May during the pandemic and economic shutdown, so that's great. and the confidence that this company has is outstanding. So like I mentioned, I hold shares and I'm continuing to hold shares until I see a better valuation to buy more shares. So right now I'm collecting the dividends from the company and reinvesting it somewhere else, not reinvesting it back at the company because I find it overvalued or fairly valued. So again, make sure to subscribe to the channel if this is your first time visiting for tomorrow's video of the next Dividend Aristocrats that we're going to be covering. So I'll see you guys tomorrow. Have a good one.